Imagine your morning, that first cup of coffee, maybe feeding your pet, grabbing a quick, healthy snack later on. What if I told you there's, well, one global titan whose products likely touch nearly every part of that routine? We're talking about Nestlé. Welcome back to the Deep Dive. Here we sift through a stack of sources articles, research our own notes, and pull out the most important nuggets, really giving you a shortcut to being well-informed. Today, our mission is to peel back the layers of Nestlé S.A., that's N-E-A-S-N, on the Swiss exchange, the world's largest food and beverage company. We're going to unpack the strategic crossroads it's facing right now, really get into its formidable strengths, dissect its challenges, and explore the bold, sometimes kind of risky moves it's making to secure its future. It's a fascinating look at how consumer powerhouse navigates a world that's, well, changing at lightning speed.
And this deep dive is for you. Whether you're tracking global economic trends, curious about the forces shaping what ends up in your shopping cart, or, simply want to understand how the brands you trust are evolving. By the end of this, you'll have a much clearer picture of the sheer power and the intricate dance of strategy behind one of the biggest players impacting our daily lives.
So let's just jump right into it. When we talk about Nestlé, we're really talking about an unseen giant. To truly grasp its influence, we first need to set the stage. The sheer, almost, incomprehensible scale of the global food and beverage sector itself. This isn't just a big market, it's absolutely colossal.
Colossal might actually be an understatement. Just last year, 2023, this market was valued at a staggering $8.7 trillion. And it's not plateauing either. Projections show it hitting $9.2 trillion this year, 2024. That demonstrates a really robust 5.6% compound annual growth rate, or CAGR.
Wow.
Yeah, and even a subsegment like beverages is forecast to grow at almost 6% annually between 2025 and 2030. These aren't just big numbers. They represent an immense, constantly expanding pie.
An $8.7 trillion market, growing at over 5% annually. That's just immense. What do you think is really fueling that kind of consistent, powerful growth?
Well, it's primarily driven by two very powerful interconnected forces, really. Demographic and economic forces. Rising disposable incomes and the rapid expansion of middle-class populations, especially across emerging economies, think Asia, Africa, Latin America. As more people around the world have more money in their pockets, they naturally seek out more diverse, often, higher quality food and beverage options. This creates a powerful tailwind for companies that can effectively tap into those growing markets.
Okay, and here's where it really gets interesting for your shopping cart, because these huge market numbers are also being reshaped by some powerful consumer-led trends. The first one that jumps out is this massive shift towards health, wellness, and what's being termed precision nutrition. This feels like a fundamental reevaluation of what food means to us.
It absolutely is. Consumers are moving from reactive health management, like treating sickness, to a much more proactive stance. They're demanding functional foods and beverages that offer specific benefits, think ingredients that support gut health, aid weight management, boost immune function, or even contribute to mental well-being. We're also seeing a strong pull for clean labels products with recognizable minimal ingredients, along with reduced sugar and sodium, and fortified options packed with essential vitamins and minerals.
Right. And it's not just general wellness, is it? We're seeing a fascinating, almost disruptive trend with the rise of GLP-1 weight loss medications. How is that redefining food as medicine and impacting how companies like Nestlé think about product development?
That's a critical and actually surprisingly nuanced point. For consumers on these GLP-1 medications, the focus isn't solely on reducing calories for weight loss anymore. It fundamentally shifts to ensuring they get essential daily nutrients from less food. So this drives demand for highly nutrient-dense, protein-rich, and often tailored products. Yeah, it transforms the food as medicine concept from just general health benefits to very precise, targeted nutritional support for a specific growing segment of the population. It's a challenge, sure, but also a massive opportunity for innovation.
We're also seeing a huge trend towards premiumization and experiential consumption.
Yeah.
How does that manifest in what we see on the shelves?
Well, younger demographics, particularly millennials and Gen Z, seem increasingly willing to pay more for unique flavor experiences, indulgent treats, and products made with high-quality, recognizable ingredients. It's not just about sustenance anymore. It's about the pleasure, the story, the experience of food.
Right.
This trend actively fuels innovation across categories and allows brands that can deliver on that promise of quality and novelty to command higher price points. Think of like artisanal coffees or gourmet chocolate. It's more than just taste,
Then there's conscious consumerism, which is
Yeah.
driving a huge demand for sustainability and transparency. This isn't just good PR anymore, is it? It feels like it's impacting purchasing decisions directly.
Not at all. It's a major force shaping market dynamics now. Consumers are actively preferring products with responsibly sourced ingredients, eco-friendly and recyclable packaging, and transparent supply chains. Concepts like carbon labeling, where a product's carbon footprint is right there on the package, and regenerative agriculture are becoming key differentiators, influencing purchasing decisions far beyond just taste or price. It's about aligning values with consumption.
Yeah, makes sense. And finally, our busy on-the-go lifestyles demand convenience and digitalization. How is it playing out for a company as immense as Nestlé?
Our modern lives absolutely demand convenient formats, ready-to-drink beverages, easy-to-prepare meals, snacks that fit into a fast-paced day. At the same time, digital transformation is enabling entirely new business models. This includes the rise of direct-to-consumer or D2C channels and hyper-personalization, where products and marketing can be tailored to individual preferences at a scale we've never really seen before.
Hmm.
It's about meeting the consumer wherever and whenever they are, basically.
So, on one hand, it sounds like there are powerful tailwinds pushing the industry forward, offering immense growth opportunities. But I'm guessing it's not all smooth sailing for a company like Nestlé, right?
Mm.
What are some of the significant headwinds facing the sector right now?
That's a crucial counterpoint. There are indeed significant challenges. We have persistent global inflation impacting raw materials, packaging, energy costs that eats directly into profit margins.
Right.
Ongoing supply chain disruptions, whether from geopolitical events or the increasingly unpredictable impacts of climate change, continue to create uncertainty and increase operational complexity. And of course, there's a constantly evolving global regulatory landscape. Food safety, labeling, marketing, environmental standards, which adds layers of compliance complexity, especially for global players operating across, 185 countries?
Yeah, exactly. That brings us squarely to Nestlé's market dominance and competitive positioning. We started by calling it an unseen giant, but unparalleled scale really highlights its unique place in the market. How exactly do we quantify that?
It's truly unparalleled. Nestlé isn't just a large food and beverage company. It is, by revenue, the world's largest. To help you visualize this, as of 2024, it operates 337 factories in 75 countries, employs over 277,000 people globally, and its products are sold in 185 nations. Think about that sheer global reach.
Wow.
There are very few companies, very few, that can claim that kind of footprint.
That's an astonishing geographic footprint. How diversified are those sales and where are they finding growth?
Their sales are remarkably diversified, which is a key strength. North America accounts for about 35% of total sales, Europe 24%, Asia, Oceania, and Africa, AOA 21%, Latin America 14%, and Greater China 6%. What's really crucial here is that emerging markets collectively contribute a significant 40% of their total group sales.
40%.
Yeah, this highlights their strategic importance as the primary engines for future long-term growth, even with the added economic and currency volatility those markets can bring. You have to manage that risk.
And in terms of specific product categories, where does Nestlé truly flex its market muscle? Where does it really dominate?
They hold leading market shares in several core categories. Take coffee, for example. Nestlé is the undisputed global leader with approximately 25% market share in the in-home coffee segment.
25%.
Yes, and they hold the #1 position in every geographic zone, driven by iconic brands like Nescafé, Nespresso, and their highly successful licensed Starbucks at-home portfolio. That's a real powerhouse.
And their pet care division, Purina, is another absolute behemoth, isn't it?
It definitely is. Purina is the strong global #2, holding about 20.7% market share just behind Mars. What's perhaps even more impressive is that they're #1 in North America and have been steadily gaining global share. In specific U.S. subsegments, their dominance is even more pronounced, for instance. They command a remarkable 76.4% share in economy wet cat food and 48.2% in mid-priced dry dog food. That's a profoundly powerful and, sticky position.
Wow. What about nutrition and health science? That seems like a really active and growing area for them, almost like a strategic pivot.
You're right to call it a pivot. It is a key strategic growth platform for Nestlé now. They are a global leader in infant nutrition. That's a historical strength. But they've been very aggressively expanding their vitamins, minerals, and supplements VMS business through major acquisitions recently. This shows a very clear strategic shift towards health-focused segments that offer higher growth and potentially higher margin potential.
And confectionery. Many people know Kit Kat, but what's their global standing there?
Nestlé is the #3 global player in confectionery. Kit Kat is their flagship brand, holding the #1 position as a chocolate bar globally, well, excluding the US where Hershey has the license, but internationally it's huge.
Right. Got it. Finally, dairy. It's such a fundamental category. How do they stack up in that competitive space?
They are consistently among the top global dairy companies by revenue. However, it's worth noting, and management has acknowledged this, that they've experienced some recent market share losses in this highly competitive segment. It's definitely an area they're actively working to strengthen and innovate in.
Okay, so we've established Nestlé's massive scale and market leadership. But how does a company this big, operating in such a dynamic and competitive environment, protect its turf? Here's where it really gets interesting for understanding its economic moat, a concept Warren Buffett popularized to describe sustainable competitive advantages. What, in your view, are the key pillars of Nestlé's moat?
Nestlé's moat is built on several extremely robust pillars, making it very, very difficult for competitors to challenge effectively. First, and perhaps most visibly, are its intangible assets, specifically brand strength. We're talking about an incredible portfolio of over 2,000 brands.
2000.
Yeah, including more than 30 billionaire brands like Nescafé, Nespresso, Kit Kat, Maggi, Purina, each generating over £1 billion in annual sales. This commands immense consumer loyalty, trust, and crucially, pricing power. The parent Nestlé brand itself was valued at $20.8 billion in 2022, making it the most valuable food brand in the world.
Wow.
This deep brand equity significantly lowers marketing costs for new product launches because consumers already trust the name. It's a huge barrier to entry for newcomers.
So their brands do a lot of the heavy lifting. But brand loyalty can sometimes be fickle, right? What about something more structural, like cost advantages?
That's the second crucial pillar. Cost advantages stemming from economies of scale. As the world's largest food company, Nestlé benefits from just unparalleled scale in procurement, manufacturing, and logistics. Consider this staggering fact. They purchase approximately 10% of the world's entire coffee production.
10% of the world's coffee.
Yes, that gives them enormous negotiating leverage with suppliers, securing lower prices for raw materials, and creating a structural cost advantage that smaller rivals simply cannot match. Their vast global manufacturing and distribution network further compounds these efficiencies.
And the third pillar, which I think often gets overlooked when people think about big consumer brands, is their sheer distribution network.
You're absolutely right. It's a critical, often underestimated component of their moat. Nestlé functions as a core supplier to grocery retailers globally. It ensures deep and broad market penetration in 185 countries. Their products are literally available whenever, wherever, and however consumers want to buy them. This extensive reach makes it exceptionally difficult and prohibitively expensive for new entrants to achieve comparable shelf presence and market access. It's a physical barrier almost. And what's truly fascinating here, especially when we talk about its defensibility, is that while brand strength and economies of scale are obvious advantages, Nestlé's deepest moat, particularly in high-growth emerging markets, really lies in its profoundly entrenched local infrastructure. Think about the milk roads they established decades ago in China to source dairy directly from local farmers, or their extensive network for coffee beans in Vietnam.
Right, they built it from the ground up.
Exactly. This isn't just about distribution channels. It's about building intricate local sourcing networks, fostering strong regulatory relationships, and cultivating deep-seated consumer trust over generations through localized products. This first-mover advantage in physical and social infrastructure, combined with local sourcing and regulatory relationships, is far more difficult and costly for new competitors to replicate. It makes its position in these rapidly expanding markets structurally stickier, more durable than in developed markets where infrastructure is often more of a shared commodity.
That's a powerful point about local infrastructure. It really moves beyond just selling a product to managing a complete ecosystem. Now that we've painted a picture of Nestlé's global scale and the trends shaping its market, let's dive deeper into how this titan actually operates day to day and fuels its innovation engine. Section 2. The heart of the business operations and innovation. Let's start with their diversified portfolio. How exactly does Nestlé generate its massive revenue across its various businesses?
Okay, so in fiscal year 2024, Nestlé's revenue clocked in at CHF 91.4 billion, generated across 7 distinct product categories. The portfolio is clearly led by 2 powerhouse segments: Powdered and liquid beverages, which is predominantly coffee, accounted for CHF 24.6 billion, representing about 26.9% of total sales. And then pet care generated CHF 18.9 billion, or 20.7%.
So if I'm doing the math right, nearly half of their total revenue comes just from coffee and pet care. Does that mean these are also their primary engines for profit and growth?
Precisely. Together, those two categories represent almost 48% of total revenue and are indeed their primary profit and growth engines. Pet care and coffee are absolutely critical for their financial health, consistently delivering high underlying trading operating profit, or UTOP margins. Remember, that's their core operating profitability.
Right.
Pet care was at 20.7% and coffee around 20% in 2023. These strong, consistent cash flows are essentially what fund investments across the rest of their vast and varied portfolio.
And what makes up the rest of the pie? What are the other categories?
The other significant categories include nutrition and health science at 16.5% of sales, prepared dishes and cooking aids at 11.7%, milk products and ice cream at 11.4%, confectionery at 9.2%, and watered down at 3.5%. So it's a broad and somewhat complex mix, but definitely with clear leaders driving profitability.
We talked about geographic diversification earlier. How does that translate into revenue breakdown? Where's the money coming from geographically?
North America remains their largest and, importantly, most profitable zone, contributing 35% of total sales. However, this mature market has faced some recent challenges, with demand softening a bit. In contrast, emerging markets, which include Asia, Oceania, Africa, Latin America, and Greater China, collectively represent a significant 41% of sales and are really the key long-term growth drivers. Though, as we noted, they do come with higher economic and currency volatility, which needs careful management. That's the trade-off.
Okay, next up, let's talk about operational excellence and their supply chain. For a company this complex, this global, its backbone must be incredibly robust.
Their operational capabilities are, well, without exaggeration, a huge competitive advantage. Nestlé boasts a vast manufacturing footprint, 337 factories in 75 countries, including 79 right here in the U.S. This distributed network is incredibly strategic. It enhances supply chain resilience and allows them to tailor products to specific local preferences and regulatory environments. It's a very sophisticated setup, not just about scale.
And we also talk about this elaborate farm-to-fork ecosystem. What does that entail on a day-to-day basis? It sounds massive.
It is an incredibly intricate system. They source raw materials from over 5 million farmers globally, working with a highly diverse network of suppliers. Their supply chain management emphasizes responsible sourcing, really stringent quality control, and maximizing efficiency at every single step. They also use Global Procurement Hub to centralize purchasing for key commodities, which again amplifies their negotiating power and drives significant cost efficiency. Scale matters there.
And they're not content to just let things run. They're constantly looking for ways to improve, right? I heard about a new cost-saving program.
Absolutely. Continuous improvement is really core to their philosophy. They actively use lean manufacturing principles to eliminate waste and boost productivity across their operations. And yes, they've launched a new Fuel for Growth cost savings program, targeting CHF 2.5 billion in savings by the end of 2027.
That's a lot.
It is. And the explicit strategic goal here is to free up those resources to fund increased investments in marketing and innovation, not just to boost the bottom line immediately. It's about reinvesting for future growth.
That focus on reinvestment leads us perfectly to their innovation engine. Nestlé has a significant R&D presence, but my understanding is they're undergoing a pretty significant strategic shift in how they innovate. What's changing?
They certainly are. They operate the largest R&D network in the entire food industry, with an annual investment of approximately CHF 1.7 billion, which is about 1.9% of sales. It's a massive commitment. They have over 4,000 scientists across 40 R&D centers globally. Historically, yeah, they were known for launching a very high volume of new products, maybe too many. Now it's a much more disciplined, fewer, bigger, better philosophy.
Fewer, bigger, better. What does that look like in practice for a company that used to launch, you said, over 1,000 products a year?
It means they're cutting the number of annual new product launches by about half. They're concentrating their substantial resources on a smaller number of high-impact, big bet projects that have clear global scaling potential. These projects are strategically targeted at 6 specific high-growth consumer opportunity areas. Nutrition across all life stages, replicating that coffee shop experience at home, mindful snacking, affordable nutrition solutions for emerging markets, new exciting flavors and textures, and even modern cooking solutions like products specifically designed for appliances like air fryers.
Interesting. And it sounds like technology and digitalization aren't just supporting this new innovation model, they're actually at its core.
You hit the nail on the head there. They're making substantial, really cutting-edge investments in digital tools. This includes proprietary generative AI for rapid concept generation, which is shortening ideation time from months to mere weeks. They're using virtual reality for prototyping and digital twins for optimizing industrialization processes.
So less trial and error, more simulation.
Exactly. This isn't just incremental improvement, it's a foundational shift in how they develop and launch products. And if we connect this to the bigger picture, Nestlé's establishment of a new deep tech center in Switzerland in 2025, dedicated specifically to AI, robotics, and smart systems. Well, that signals a truly fundamental strategic shift. They're moving from being a traditional food science company towards becoming, quite deliberately, a technology-enabled food company.
A technology-enabled food company.
Yeah. And this raises an important and, frankly, provocative question for all of us. What does that truly mean for the future of food production and consumption? Is it about ultra-personalized nutrition delivered right to your door? Fully automated kitchens anticipating your cravings? Or maybe something entirely different that we can't even fully imagine yet? It's a very intriguing pivot that suggests the future of food might look less like a farm and, well, maybe more like a data center.
That's a genuinely thought-provoking vision, linking food science directly to deep tech. Now let's talk numbers. Section 3, the financial pulse and strategic choices. We're going to look at a decade of their financials, roughly 2015 to 2024, because the numbers always tell a compelling story about a company's health and direction, don't they?
They certainly do. In terms of reported revenue in Swiss francs, or CHF, it's actually been relatively flat, moving from about CHF 88.8 billion in 2015 to CHF 91.4 billion in 2024. But here's the nuance. This isn't necessarily a sign of stagnation. Rather, it reflects two key things. First, active portfolio management, meaning they've been divesting slower growth businesses. And second, the persistent strength of the Swiss franc, which creates a negative translation effect on foreign sales when converted back to their reporting currency.
Right, the strong franc makes overseas earnings look smaller. So for a global giant like Nestlé, organic growth is the real pulse check, isn't it? That strips out currency and M&A effects. How has that been performing?
Absolutely. Organic growth is the true underlying performance indicator. They delivered a strong 7.2% in 2023, but that was largely driven by necessary price increases to offset inflation. However, it moderated significantly to 2.2% in 2024, which directly reflects the impact of that pricing on consumer volumes. You can only raise prices so much before consumers start pushing back or trading down.
And real internal growth, or RIG, that's the volume part, right? Where genuine consumer demand shows itself. How has that been tracking?
RIG is crucial because it measures volume growth, essentially how much stuff people are actually buying. It was actually negative, at negative 0.3% in 2023, showing that those price increases were indeed impacting volumes. However, it did improve to a positive 0.8% in 2024. For investors, a sustained return to positive RIG is a key signpost that the company is winning back volume without solely relying on price hikes anymore. That's what they want to see.
How about their margin evolution? Protecting profitability amidst all that inflation must have been a huge challenge.
It was indeed. Their gross margin, a key indicator of profitability at the product level, contracted to a low of 45.4% in 2022 due to that accelerating input cost inflation. But through disciplined pricing and efficiency measures, it recovered nicely to 46.1% in 2023 and then 46.7% in the last 12 months, ending June 2025. Their underlying trading operating profit, or UTTOP, margin, remember, that's their core operating profitability, before interest and taxes has been pretty robust, hovering between 17.1% and 17.7%. However, they've guided for a slightly lower UTTO margin of at or above 16.0% for 2025.
And why that guided step down in margin? That sounds a bit counterintuitive if they're aiming for growth.
It's a very deliberate strategic decision. It reflects their commitment to significantly increase investments in marketing and grant support. The goal is to reignite volume recovery and invest in future growth areas, even if it means a temporary dip in reported profitability in the short term. It's a calculated reinvestment for longer-term gains. They're willing to sacrifice a bit of margin now for growth later.
In terms of overall profitability and returns for shareholders, what do the numbers say about Nestlé's financial health? Things like ROE and ROEC.
Return on equity, or ROE, has been consistently strong, generally above 20% since 2019, even reaching an impressive 33.8% in 2024. We should note, though, that this higher figure is partly influenced by an increased use of debt, which can magnify returns on equity.
Okay.
More importantly, perhaps, is return on invested capital, or ROIC, which measures how efficiently they're using all their capital, debt, and equity. That has been remarkably stable between 12.7% and 13.4% from 2021 to 2024. This consistently strong ROIC is a clear signal of very disciplined and effective capital allocation over time.
Let's delve into the power of their cash flow and working capital management. For a company of Nestlé's size, being efficient here must be a massive competitive advantage.
It absolutely is. Nestlé is a formidable cash generator. Their free cash flow, FCF, jumped significantly to CHF 10.4 billion in 2023, up from CHF 6.6 billion in 2022. This impressive improvement was largely driven by a substantial reduction in working capital needs. Their operating cash flow alone was CHF 15.9 billion in 2023. That's just a river of cash flowing through the business.
What's truly fascinating here, and quite rare for many companies, is that Nestlé often operates with what's called negative working capital. Can you explain what that means and why it's so exceptional?
Right. Operating with negative working capital is an exceptional and powerful feat for any company, and particularly for one of Nestlé's scale. It essentially means they are so dominant in their markets, they effectively get their suppliers to finance their operations. They collect money from customers before they even have to pay their own suppliers for raw materials and stock. It's like getting an interest-free loan from your supply chain.
How do they manage that?
If you look at their cash conversion cycle, or CCC, days sales outstanding, DSO, which is how fast they collect payments from customers, is stable around a quick 36 days. Days inventory outstanding, DIO, how long they hold inventory, actually increased from 83 days in 2020 to 98 days in 2023. That was a deliberate strategy to hold more stock to mitigate supply chain risks during that volatile period. But their days payable outstanding, DPO, which is how long they take to pay their suppliers, is consistently high at around 114 days. That extended payment term to suppliers is a clear reflection of their significant market power. They can dictate terms.
So they're essentially getting their suppliers to fund a portion of their operations for almost 4 months, which is incredibly powerful. But does this model create any potential vulnerabilities? Is there a downside?
It definitely does create a potential vulnerability. This powerful model relies on two key assumptions: relatively stable supply chains and predictable consumer demand. If suppliers were suddenly to demand shorter payment terms due to their own financial pressures, or if Nestlé needed to hold even more safety stock due to heightened disruptions, this crucial internal financing source could erode quite quickly. That would put direct pressure on future free cash flow generation and could force them to find external financing, which would obviously be more costly. So it's a finely balanced system that works well when things are stable but has inherent risks.
Let's shift to their disciplined capital allocation strategy. It's often been described as a shrink-to-grow approach under the current CEO, which sounds intriguing. How does that work?
It is absolutely central to their current strategic playbook. First off, Nestlé has an unwavering commitment to its dividend. They boast an impressive 29 consecutive years of dividend growth.
29 years.
Yes, that's a huge attraction for income investors, and it's something they clearly prioritize. The proposed CHF 3.0 per share for 2023 gives an attractive forward yield of about 4.2%, and crucially, it's well covered by their robust cash flow, with a sustainable payout ratio of approximately 70%. That's a very reliable income stream for shareholders.
They also use share buybacks as a significant tool for capital allocation, don't they? Returning cash that way, too.
Yes, share buybacks are a primary way they return excess capital to shareholders when they don't see better internal investment opportunities or acquisitions. They completed CHF 20 billion programs both from 2020-2022 and another one ending by the end of 2024. This supports their earnings per share growth by reducing the number of outstanding shares, which can be an attractive way to boost shareholder value, especially when the stock price is seen as reasonable.
And their M&A strategy, the portfolio optimization part, seems incredibly aggressive and focused under CEO Mark Schneider. This is the shrink to grow a bit.
It has been profoundly transformational, yes. Under his leadership, Nestlé has systematically divested slower growth, lower margin, or simply non-strategic assets. This isn't random. It's a very deliberate strategy to reallocate that capital into high-growth, high-margin areas. This active portfolio rotation has impacted roughly 20% of its sales base since 2017. That's a massive reshaping for a company of its size and history.
Can you give us some concrete examples of those major divestitures and acquisitions? Who did they let go and who did they bring into the fold? What kind of businesses?
Certainly. Major divestitures include their U.S. confectionery business for $2.8 billion, Nestlé Skin Health for a hefty $10.6 billion, the U.S. ice cream business for $4 billion, and most of its North American waters business for $4.3 billion. These were generally seen as lower growth or lower margin areas. On the acquisition side, they've been very strategic, focusing on those growth pillars, notably acquiring the Starbucks consumer packaged goods perpetual license for $7.15 billion, a huge boost to their coffee dominance. They also bought Atrium Innovations for vitamins at $2.3 billion, and the Bountiful Company's core brands, also in VMS, for $5.75 billion. These moves are all about strengthening their high-growth platforms in coffee, pet care, and health science.
So what does this aggressive portfolio management, this shrink-to-grow strategy, really mean for Nestlé's overall direction and for investors looking at the company? It sounds quite dynamic.
This active portfolio management is a core financial and strategic lever that really cannot be overstated. It signals that Nestlé is acting less like a static, traditional food producer and more like an active portfolio manager, constantly optimizing its mix of businesses for growth and returns. Future performance in this model depends as much on disciplined capital allocation and their ability to successfully pivot their portfolio as it does on day-to-day operational execution. It's a very dynamic and deliberate strategy to try and stay ahead in a fast-changing market. They're not afraid to make big changes.
Now that we've dissected the financial pulse and strategic choices, let's explore Section 4, the path forward, strategic levers, and recent headwinds. What are the key growth drivers Nestlé is focusing on to really fuel its future, particularly in light of these strategic pivots we just discussed?
Well, a central and consistent pillar across nearly all categories is premiumization. They're constantly trying to get consumers to trade up. You see this clearly with Nespresso and Nescafé Dolce Gusto for those sophisticated at-home coffee experiences, and the acquisition of super premium brands like Blue Bottle Coffee. In confectionery, it's the global expansion of Kit Kat and acquiring premium chocolate brands like Copenhagen in Brazil. And in pet care, science-based brands like Purina Pro Plan now make up 2/3 of the category and are its primary growth engine. It's all about increasing the perceived value and, ultimately, the profit derived from each consumption moment.
Emerging markets still seem to be an absolutely crucial long-term growth engine for them, where they've had such a long-standing presence. How is their strategy evolving there, given the volatility?
They've got a deep history there, and it remains absolutely critical for long-term growth. Their strategy involves early market entry, meticulously building that local infrastructure we talked about earlier, and adapting products to specific local tastes and affordability levels. That last part is key. They have an affordable, accessible nutrition platform, for example, fortifying staples like Nido powdered milk and Maggi culinary aids with micronutrients to address specific local nutritional needs at affordable price points. Key markets, like India, with its urban focus targeting both rural and urban distribution effectively, and Latin America, where they're actively investing in local agri-food tech startups, are prime examples of this tailored, long-term, embedded approach.
And health science is being aggressively built out as that third major growth platform. What does that look like in terms of product development and market focus? What are they actually doing there?
Yes, it's explicitly being positioned as their third major growth platform, designed to stand alongside the powerhouses of coffee and pet care. They're combining organic innovation from their own R&D with those strategic acquisitions, like the VMS brands, to target high-growth health and wellness segments. This includes healthy aging, weight management, and crucially developing products specifically designed to support users of those GLP-1 medications, which we touched on earlier, and personalized nutrition solutions. It's a very forward-looking approach that leverages science and key consumer health trends.
Nestlé is also making significant investments in digital transformation and direct-to-consumer DTC channels. How absolutely critical is e-commerce for a company this size, which has historically relied so heavily on traditional grocery retail?
E-commerce has become absolutely critical, transforming from just another channel to a core strategic pillar for them. Their e-commerce sales grew organically by an impressive 15.1% in the first quarter of 2025 alone, reaching 20.1% of their total group sales. Their ambition is to get that number up to 25% of total sales from e-commerce by 2025.
A quarter of their sales online.
Yeah. It's huge, and this digital shift is backed by a substantial planned increase in online marketing investment, targeting 70% of their total marketing budget going towards digital channels by 2025. This isn't just about selling online, it's about fundamentally reshaping their entire marketing approach and how they reach consumers.
And this D2C expansion, building direct relationships with consumers, what's the ultimate goal there? Is it just about cutting out the retailer and making more margin cent?
It's about much more than just sales or margin, actually. The primary goal is to build direct relationships with consumers to gather incredibly valuable first-party data, what people buy, when, why. This data then enables them to enhance personalization, significantly improve marketing effectiveness, targeting the right people with the right message, and foster greater brand loyalty over time. They've set an ambitious goal to reach 400 million consumers through their first-party database by 2025. While Nespresso is a mature D2C example, they're expanding this with services like Ready Refresh water delivery in the US and Tails.com personalized pet food in Europe. It's about owning that customer journey from start to finish. And, this aggressive D2C and first-party data strategy serves as a truly crucial defensive move for Nestlé, too. As large retailers consolidate power and increasingly promote their own private label brands, owning that customer relationship directly becomes essential for Nestlé.
Right, bypassing the shelf competition to some extent?
Exactly. It allows them to maintain pricing power, control their brand narrative without a middleman interpreting it, and avoid being commoditized on the retail shelf, whether that shelf is physical or digital. It's about building a direct, defensible connection with you, the consumer.
Sustainability is also front and center for Nestlé, not just as, good PR, but increasingly as a core business strategy and a value creator. What does their net zero roadmap entail, and how is regenerative agriculture fitting into that picture?
Regenerative agriculture is the absolute cornerstone of their net zero roadmap. They're investing significantly billions to help their farming partners improve soil health, enhance biodiversity, and sequester carbon right there in the ground. Their aim is to source 20% of key ingredients from regenerative agriculture by 2025 and an ambitious 50% by 2030.
50%.
Yes. And this isn't just an environmental initiative. It's a critical long-term strategy to de-risk their essential agricultural commodity supply chains from the unavoidable impacts of climate change. It's about ensuring a resilient raw material supply for decades to come, which is vital for their business continuity.
And what about sustainable packaging and water stewardship, which are also massive concerns for consumers and often points of criticism for large companies?
They've made public commitments there, too. They aim to reduce virgin plastics use by 1/3 by 2025 and design over 95% of their plastic packaging for recycling by that same year. Still a challenge, but clear targets. For water, which is a particularly sensitive topic for a company of its scale, especially their bulky water business, they have ambitious water reduction targets at all their manufacturing sites and a pledge for achieving positive water impact in key watersheds by 2025, essentially aiming to replenish more water than they use in those areas.
So these initiatives aren't just about environmental impact statements. They're truly integral to their business model and designed to resonate with increasingly conscious consumers like us. It's table stakes now, almost.
Exactly. They're crucial for maintaining the company's social license to operate and for connecting with increasingly conscious consumers who demand more, and rightly so, from the brands they choose to support financially. It's a commercial imperative as much as it is an ethical one these days.
Okay, let's turn to some critical analysis of recent headwinds and developments from, say, 2023 to 2025. It hasn't exactly been an easy operating environment lately. How has Nestlé navigated this intense inflationary period?
Yeah, the global surge in inflation has had a profound impact across the board. To offset those record input costs, Nestlé implemented substantial price increases. You probably noticed them on the shelves. Pricing contributed 8.2% to organic growth in 2022 and another 7.5% in 2023. And those pricing actions continued into 2024 and 2025, particularly for categories like coffee and cocoa, where commodity prices remained exceptionally volatile and hit historical highs.
But those significant price hikes had a consequence, didn't they, on the actual amount of stuff people were buying, on sales volumes?
Precisely. The strategy, while arguably necessary to protect margins, came at a cost. Those price hikes directly led to negative real internal growth, RG, their volume growth metric, of -0.3% in 2023. Consumers reacted to higher shelf prices, leading to a dip in sales volumes and generally softer demand across many categories. The central challenge now for management is to restore sustained positive RIG without completely sacrificing the profitability gains they achieved from that pricing.
It's a tough balancing act.
It really is. The easy gains from just raising prices are likely exhausted in most markets, so now they need to really innovate and market more effectively to justify those prices and drive volume.
And how did this balancing act impact their margins? That all-important UTPAP margin we discussed earlier. Did pricing fully offset the cost increases?
Not entirely, no. Despite the aggressive pricing, their underlying trading operating profit, UTOP margin, remained under pressure from those persistent cost increases, particularly in energy and packaging. It recovered slightly to 17.3% in 2023 after a dip in 2022, but as we noted earlier, they've guided for a slightly lower margin of at or above 16.0% for 2025. This reflects not only ongoing cost pressures, but also, as we discussed, that strategic decision to significantly reinvest in marketing and brand support to try and drive that volume recovery. It's a calculated decision to trade some short-term margin for potentially stronger long-term volume growth.
They've also been accelerating their portfolio reshaping and strategic pivots during this period. What does that involve, particularly with any underperforming assets? Are they cutting things loose?
Yes, management has publicly identified 18 underperforming business cells, specific brand market combinations that are currently under rigorous review for either turnaround or potential divestiture. This shows they're being quite decisive, maybe more so than in the past, in addressing areas that simply aren't meeting their stringent internal performance expectations. It's an active pruning process to focus resources.
I also saw something intriguing about a review of their VMS business, vitamins, minerals, and supplements. That sounds like a significant pivot, especially given some fairly recent large acquisitions they'd made in that space. What's happening there?
It is a very significant pivot, yes, within their health science division. They've launched a formal strategic review of their mainstream and value VMS brands. This includes major names acquired relatively recently with Bountiful Company, like Nature's Bounty and Osteobiflex. This review may very well lead to their sale, which is notable just a few years after that substantial $5.75 billion acquisition.
Wow, that's quick.
It is. The future strategy, it appears, will concentrate much more narrowly on the premium end of the VMS market, with brands like Garden of Life and Solgar, which they believe have stronger growth and margin profiles. But it certainly raises important questions about the initial M&A due diligence for those mass market brands, and perhaps Nestlé's ability to effectively compete in that highly crowded, promotion-driven, and competitive space against specialists.
And their waters business is also undergoing some reorganization post-divestiture of the North American bulk brands.
Yes, following that big 2021 sale of its North American mass-market water brands like Poland Spring and Pure Life, the remaining premium water and beverage business, think Perrier S. Pellegrino, will now operate as a standalone entity within Nestlé. This structural change is designed to better address the specific needs and dynamics of that unique, more premium category. And management is openly exploring further strategic options, which could include potential partnerships or other structural changes down the line. It's another clear move towards refining the portfolio and focusing investment.
Beyond these internal strategy shifts, what macroeconomic and geopolitical factors are Nestlé grappling with on a global scale right now?
Well, the persistent strength of the Swiss franc, CHF, against other major currencies has been a significant currency headwind for them as a Swiss-based company. It had a negative impact on reported sales of negative 7.8% in 2023 and negative 3.7% in 2024. That effectively masks some of the underlying positive operational performance when translated back into francs for reporting.
Right, makes the growth look weaker than it might be in local currencies.
Exactly. Supply chain pressures also remain a concern. While maybe the acute disruptions of the pandemic era have eased somewhat, the global supply chain is still vulnerable to geopolitical tensions, like conflicts impacting key shipping lanes and climate-related events, such as extreme weather impacting harvests for coffee or cocoa. Nestlé has explicitly increased inventory levels as a mitigation strategy against this uncertainty, but this, of course, ties up cash and impacts working capital efficiency.
And the regulatory landscape continues to evolve, adding complexity, sometimes in unexpected ways, like that deforestation rule you mentioned.
Indeed. A key area on the horizon is the upcoming implementation of the EU Deforestation Regulation, or EUDR. This will introduce quite stringent due diligence requirements for companies importing commodities like cocoa, coffee, soy, and palm oil into the EU. Nestlé actually publicly supports this regulation, viewing it as a way to create a more level playing field for companies like themselves that have already invested heavily in building more traceable and sustainable supply chains. It potentially disadvantages competitors who haven't made those investments yet.
All right, let's move into our final section, Section 5, the road ahead risks and valuation. We've covered a lot of Nestlé's strengths and bold strategic moves, but every company, even a titan like this, faces significant risks. What are the most comprehensive operational and financial risks for Nestlé as it navigates this complex future?
Okay, operationally and financially, first and foremost is commodity price volatility. Nestlé's profitability is directly exposed to the fluctuating prices of essential raw materials like coffee, cocoa, dairy, and grains. In 2023-2024, they faced record high coffee and cocoa prices, which directly pressured gross margins despite their hedging strategies. Sustained high costs remain a constant threat to profitability. Second, supply chain disruption remains ever present. They are vulnerable to geopolitical conflicts, climate disasters, logistics failures, any of which can lead to product shortages, higher transportation costs, and ultimately an inability to meet consumer demand, which damages sales and reputation.
What about their financial leverage, the amount of debt they carry? And critically, the risk of product quality and safety, which can hit a food company incredibly hard.
While Nestle is generally considered financially strong, their financial leverage has increased somewhat in recent years, partly due to large acquisitions and share buybacks. Total liabilities stood at CHF 83.6 billion in June 2025, which does exceed their readily available cash and receivables. Rising interest rates would increase their debt servicing costs, so that's a factor to watch carefully. And for any food company, but especially the world's largest, quality and safety are absolutely paramount. Product contamination, mislabeling, or any quality control failure can lead to incredibly costly recalls, severe legal liabilities, and perhaps most damagingly, irreparable harm to consumer trust and their invaluable brand reputation. That's a risk they simply cannot afford to get wrong ever.
Beyond operations and finance, what are the broader strategic and market risks they face? The competitive landscape.
Intensifying competition is a constant battle. They face fierce rivalry not only with other global CPG giants like Unilever, P&G, Danone, and Mars, but also growing threats from agile local competitors, particularly in fast-growing emerging markets, and the ever-expanding presence of private label brands from powerful retailers, which often compete aggressively on price. Also, shifting consumer preferences pose a continuous, rapidly evolving risk. The rapid pace of change towards health-conscious choices, plant-based alternatives, personalized nutrition needs, and sustainability demands means Nestlé must innovate constantly and effectively, or risk brand irrelevance and significant market share erosion, especially among younger consumers. They absolutely cannot afford to stand still.
And their current transformation strategy, as complex and multifaceted as it is, carries its own set of significant risks, doesn't it?
Yeah.
Just managing all that change.
Absolutely. That's the execution risk. The success of the Fuel for Growth cost-cutting program, the tricky VMS business review, their planned increase in marketing investments, and the fewer, bigger, better innovation approach. Well, it all depends on simultaneous and critically effective execution across hundreds of brands and markets globally. A failure in executing any one of these major pillars could seriously derail their growth plans and potentially lead to significant shareholder value destruction. There's very little room for major missteps when you're trying to steer a ship this large through such significant change.
Finally, what about regulatory and geographic risks? For a company with operations in 185 countries, this must be a constant minefield to navigate.
It definitely is. Regulatory scrutiny is stringent and constantly evolving worldwide, covering everything from food safety standards and nutritional labeling to marketing practices aimed at children and new environmental standards, like the EUDR we discussed. Compliance is complex and costly. Emerging market exposure, while a key growth driver, inherently brings higher political instability, economic volatility, and unpredictable currency fluctuations that can severely impact reported earnings and make planning difficult. And finally, they face ongoing ethical and reputational risks stemming from past criticisms and ongoing societal concerns, such as historical issues around water usage in certain regions, infant formula marketing practices in developing countries, and ensuring ethical sourcing, like tackling child labor in cocoa supply chains. These require transparent, proactive, and continuous mitigation strategies to protect their reputation and their crucial social license to operate.
You know, what's truly fascinating here, listening to all this, is how incredibly interconnected all these risks really are. For example, climate change, which is a physical risk impacting crop yields, directly contributes to commodity price volatility as a financial risk. And that heightened awareness and impact, in turn, can prompt new environmental regulations, which are regulatory risks. It really is a complex, almost systemic feedback loop that requires a truly holistic and forward-thinking approach to risk management from the company.
You've absolutely hit on a critical point. It's not about managing isolated threats in silos, but understanding and navigating a dynamic, interwoven web of interdependent challenges. Managing one effectively often means needing to manage several others simultaneously. It requires incredible coordination.
Let's shift gears slightly to their valuation perspective.
Yeah.
How is the market currently viewing Nestlé, particularly with all these challenges and strategic shifts in play? Is it seen as a safe haven or something riskier now?
Well, Nestlé's market capitalization has fluctuated quite significantly in recent years. It peaked at over $384 billion back in 2021 during a period of very strong market sentiment for stable consumer staples. However, it contracted quite a bit to a range of roughly $212 billion to $243 billion during 2024 and into 2025. This contraction is largely due to broader macroeconomic pressures like inflation and rising interest rates, which make future earnings less valuable today, as well as that persistent headwind from the strong Swiss franc impacting reported results.
Right.
Historically, the stock often commanded a premium valuation compared to peers, reflecting its stability and quality, but that premium has definitely been reevaluated by the market recently.
And what do their current valuation multiples like PE ratio tell us about investor sentiment right now?
As of late 2024 and early 2025, the multiples have definitely moderated, reflecting that reevaluation. Their price-to-earnings PE ratio is hovering around 17-18x forward earnings. That's a noticeable contraction from prior years, where it was often closer to 22x or even higher. It's now more in line with its 5-year historical average, suggesting less expectation of rapid growth baked in. Similarly, the enterprise value to EBITDA ratio is about 17.3x, also pretty consistent with its 5-year average, and the price-to-book ratio is in the range of 6.5x to 6.7x.
What's the implication of this moderation in valuation multiples? Does it suggest a wait-and-see approach from investors? Are they skeptical?
Absolutely. I think it clearly indicates the market is no longer willing to pay a significant premium solely based on Nestlé's historical reputation or future growth promises alone. Investors are now clearly demanding tangible evidence of a successful turnaround, specifically a sustained recovery in volume growth, that positive reg, and stabilization or improvement in operating margins before they'll consider re-rating the stock back to a higher multiple. This puts the onus squarely on management to deliver consistently on their strategic promises with very little cushion for execution missteps. The market is definitely in a show-me-the-results phase with Nestlé right now.
Finally, let's just touch briefly on their dividend analysis again. For many long-term investors, Nestlé has long been an investment cornerstone, precisely because of its reliable and growing dividend. How does that look today?
It absolutely is, and it remains a very attractive feature, especially in the current environment. With a forward dividend yield of approximately 4.05%, Nestlé offers a compelling income stream, particularly compared to historical yield levels for the company itself, which were often much lower. Its sustainability looks extremely high, underpinned by that impressive 29-year history of consecutive dividend growth. That shows a deep, unwavering commitment to shareholder returns through cycles. And importantly, it's well covered by that robust free cash flow we talked about, CHF 10.4 billion in 2023. A payout ratio of about 70% of earnings is generally considered very sustainable for a mature, stable company like Nestlé, allowing for both shareholder returns and necessary reinvestment back into the business for future growth. There's high confidence in its long-term dividend sustainability and potential for continued modest growth.
So to bring it all together and maybe recap the core tension we've explored today, Nestlé, this immense global titan, truly stands at a critical juncture, doesn't it? It's navigating this delicate, really challenging balance of defending its vast market share in mature, highly competitive categories like dairy or mainstream coffee, while simultaneously aggressively investing and pivoting into new, potentially higher growth areas like health science and premium pet care. It's a fascinating, high-stakes display of corporate strategy in real-time motion.
Indeed. And you can frame the investment case around this tension. The bullish argument, the optimistic view, sees Nestlé's formidable economic moat, its brand scale distribution combined with its decisive strategic pivot into those high-growth categories, plus those significantly increased marketing and R&D investments. Sees all that as the right ingredients that will ultimately restore consistent volume growth and eventually expand profitability again. From this perspective, the current, more moderate valuation could be seen as an attractive entry point for long-term investors, further sweetened by that highly reliable approximately 4% dividend yield while you wait.
But the bear case, the skeptical view, raises some really valid, challenging concerns, doesn't it?
It certainly does. The skeptical perspective argues that Nestle's sheer size, its historical bureaucracy, and its deeply ingrained processes could inherently limit its agility, making rapid adaptation difficult against nimbler new competitors and the ever-expanding threat of those aggressive private labels, especially in developed markets. They might argue that persistent inflation, the ongoing currency headwinds from the strong Swiss franc, and those significant execution risks we outlined, like successfully integrating acquisitions or turning around the VMS business, could continue to pressure margins and potentially lead to a prolonged period of stagnant growth, making the current valuation look less attractive. It's a finely balanced equation with significant risks.
So, as you, our listener, consider all of this complexity surrounding Nestle, here are maybe some big questions to mull over. Can Nestle consistently return to generating positive real internal growth, getting more people to buy more of their stuff, essentially, especially in critical mature markets like North America, where demand has been soft? Will the strategic investments they're pouring into innovation and marketing actually lead to the stabilization and eventual expansion of its operating margins back towards its medium-term targets? Or will costs remain stubbornly high? And how much traction, how much genuine market penetration and consumer excitement will its big bet innovations actually gain in a world where consumer tastes are changing so incredibly rapidly? Will they pick the right bets?
And maybe for a final provocative thought that connects directly back to that idea of the future of consumer goods we touched on earlier, considering Nestle's aggressive direct-to-consumer D2C push, its deep pursuit of first-party consumer data, and its stated ambition to become a technology-enabled food company leveraging AI and deep tech. How might this fundamentally redefine its relationship not just with you, the consumer, but also with its traditional retail partners over the next decade? What implications does this shift have for the entire consumer goods industry? And for you as a consumer, in terms of product access, the potential for hyper-personalization of your food and nutrition, and even future pricing models? It's a future that isn't just coming someday. It feels like it's already rapidly taking shape in our daily lives, often led by giants like Nestle.